Hi folks, in this video the question asked you to calculate some cash values. So you'll see in this question it's focusing on calculating any cash flow from investing activities. Now they ask you first of all to calculate the cash paid for any equipment that you purchased during 2014. Well, in order to figure out how much equipment, what the cash value was that you paid out when you bought the equipment, first thing to do would be to do an analysis of the equipment account so you know how much you actually bought. So in your equipment account, you can see from the balance sheet, you started with a balance of 300 and you ended with 328. Well, how did that happen? Well, you need to figure out how much equipment you bought and paid for in cash. Well, you know, to get from 300 to 328, you might have bought, as you say, $28 worth of stuff, but if you read the question, they told you that equipment costing $150 was sold, so you know this happened. So if you go from 300 and you sell 150, you're not coming up with 328. So that means in order to get this to work out, you must have bought equipment for 178. It didn't say in the question that whatever you bought on credit. It said, what did you buy and pay for in cash? So you must have bought this equipment and paid cash for it. So your journal entry would have been at that time to debit equipment, credit cash, and again you're going to have an investing outflow because it's an investing activity. The second part of the question said, how much cash did we get, or what were the cash proceeds for any equipment that we sold during 2014? Well, we know that we sold $150 of equipment, but how much cash did that generate for us? Well, you know that when you sell equipment, and in our case $150 worth, you dump accumulated depreciation on that equipment, you book some cash, and you have to book a gain or a loss. Well, guess what? In our question, they told us that we had a loss included in net income due to the sale of equipment. So we know the way I would do this is I would look at what's happening with my accumulated depreciation account. Well, I know that my accumulated depreciation started at 95 and it went to 100. Well, how did I get there? The question tells me that I had depreciation expense of $20 during the year. So if I did, to go from 95 to 100, given that my accumulated depreciation increased, because don't forget, I would have done a journal entry during the year, which debits depreciation expense and which is going to credit accumulated depreciation, and that would be for $20, right? So I would have done that during the year. That's where this little guy comes from. It's depreciation expense, but its little sister there on the balance sheet side is $20 to accumulated, right? So the idea is to go from 95 to 100. When I increased my accumulated depreciation by 20, I must have gotten rid of accumulated depreciation of 15 when I sold this $150,000 in $150 in equipment. So I'm going to credit my equipment, debit my loss. My loss was given to me in the question. I didn't make it up. They gave it to me, and I know accumulated depreciation is 15. So therefore, my cash to plug it in must have been 105, and that's going to be an investing inflow. Now, they didn't ask me to do a cash flow section of the cash flow statement, nothing like that, so I didn't bother to do it. All they asked me to do is to calculate the amount of cash that in Part B was received, or inflow of cash from investing activities, and in Part A, my investing outflow, which was 178 in cash. So, hope this question helps you to get a little idea of how, in fact, you can calculate inflows and outflows on investing activities when you have fixed assets.